we have a very interesting event today. This is our 13th RCI pod, and this event will be dedicated to the topic of foreign direct investment and the role of international investment agreements on foreign direct investment before and also during and after COVID pandemic. International investment agreements are the important policy tool for policymakers all around the world to attract, retain the foreign direct investment. They do involve a variety of instruments from bilateral investment treaties, BITs, today's focus, and preferential trade and investment agreements, and international taxation agreements, and double taxation treaties. Bilateral investment treaties are particularly important, have been increasingly used in the region. They are designed to safeguard economic interests of both nations and then international investors. Both parties have an interest in being part of this investment treaty. For investors, BITs can allow internationally fair treatment and legal protection from sudden changes in the government or any adverse measures imposed by the government of host states. For countries, treaties can provide an instrument also to attract investment by signaling a stable and predictable legal environment for investors. As we have seen a rise in the number of investor-state disputes, ISD, which could be triggered further by COVID-19, there are questions on the possible impact of BITs on the type and structures of Asia's foreign direct investment are going to arise. These go from assessing the FDI, different modes of entry, or to the different effects by these BIT on investment to different sectors. And those imply different also impact on certain economies. Over the past 2 years, ADB has been developing this database on investment provisions for Asia in BITs. During the seminar, we will explore some empirical models that we are proposing to develop and preliminary findings from this model to see how the structures of these treaties and the different provisions are going to affect the investors' investment decision. Within a group of experts, we'll also discuss some approaches to measure this impact and discuss if there are different factors that could be considered to assess current FDI determinants, drivers, including micro, macro, and financial risks. Finally, we'll also learn how we can work together with the governments in this area to improve the effectiveness of BITs. So without further ado, let me turn to our presenters today. We have two presentations, actually two presenters, one sharing one presentation. So we'll have Rolando, and we also have Fahad, both economists from the ERCD, who will share those proposed studies to develop further using the newly developed database on BIT and FDI, and also discuss some of the preliminary findings from this empirical models. Rolando and Fahad, you can have about 20-25 minutes for presentation.
Thank you, Sun Young. So I'll go first and present the first half of the presentation, and then Rolando will take over.
Okay.
So we are presenting a first look at a new ADB database on international investment agreements, which include bilateral investment agreements and investor chapters in regional agreements signed by Asian economies. The database updates and provides more granular information compared to an earlier version developed by Professor Julian Chase of City University of Hong Kong. In this presentation, we'll focus on bilateral investment treaties. Mara, next slide. So just to introduce and motivate the topic, the empirical literature on FDI has identified various determinants relating to comparative advantage, integration, institutional quality, and other policy factors as main drivers of FDI inflows. Amongst these, international investment agreements, in particular BITs, have become an important and increasingly frequent policy instrument to attract FDI by safeguarding the economic interests of both the recipient economies and international investors, with provisions protecting investor rights strengthening over time. However, with the proliferation of BITs, we find that there's no standard template, and the heterogeneity of BITs in terms of focus on different provisions has been increasing. So this leads us to the question of how effective are BITs in facilitating FDI, given that they are an increasingly employed instrument of international investment policy. The empirical evidence on the effectiveness of BITs so far is quite mixed, and we contribute to this literature by examining the impact of BITs depending on FDI's mode of entry, sector, or industry, and also going deeper into the types of BITs in terms of the generation, that is when they were signed, and the different templates. Templates may refer to the broad groups of BITs that may be signed. So for example, intra-Asian BITs may have a focus on certain provisions versus BITs signed by Asian economies with the US or Europe. So we want to investigate this heterogeneity in more detail. So for this purpose, we exploit the granularity of our BIT data set, which has 15 provisions, which were coded through a detailed textual analysis. And also we disaggregate FDI flows by mode of entry and also sectors for a more detailed analysis. Next slide, Mara. So the analysis and the research questions that we present today, and this is ongoing work, was further guided by these overarching policy considerations. First, what is the role of BITs, that is these bilateral agreements in the context of regional agreements? Are regional trade and investment agreements more effective than bilateral treaties? How do the two interact with each other, and what are the trade-offs? Secondly, while investment agreements can signal a stable and predictable environment for investment and help in promoting good governance standards, are BITs a substitute for domestic reform? That is, are they a substitute for poor business environments and governance? Third, how can investor and state rights be better balanced? And how do different or competing BIT provisions interact in this regard? Example, public interest and SDG related provisions, which have become increasingly popular, may dilute investor rights versus investor state dispute mechanisms, which protect investor rights. Finally, should we promote and talk about an ideal template also in terms of capacity building, or should treaty making be more flexible depending on the circumstances of individual economies and the type of FDI that they're seeking to attract? Next slide, Mara. So these slides show FDI trends over the past 2 decades and motivates why it is important to disaggregate by mode of entry and sectors. Just as background, Greenfield FDI builds new assets versus merger and acquisitions, which refer to acquisition of existing assets. And these are the 2 modes of entry that multinationals may employ for investing in an economy. This data differs from the standard balance of payments in that it traces firm level investment activity and traces the ultimate investor ownership. The empirical literature shows that both modes of entry may have different determinants and sectoral implications. And these are the questions that we want to look at in more detail. So as the left panel shows, greenfield FDI, which has been the dominant mode of entry for FDI into Asian economies, has relatively been targeted more towards manufacturing and primary industries, while merger and acquisitions has been targeted more towards service sectors historically, which are often more regulated and protected. So the impact of BITs may differ between the two. Next slide, Mara. So just some trends showing the evolution of and the change in the composition of Asian BITs, and we have seen an increasing participation of emerging economies. That is, Asian economies have, comparing the two panels in the right-hand chart, from 1959 to 1995, Asian economies mostly signed treaties with advanced economies, but the share of emerging economies in Africa, Latin America has increased since then, signaling more developing country investment linkages. Overall, as of June 2020, nearly 3,000 agreements, including both BITs and RTIAs, had been signed globally, out of which around 1/3 involved Asian economies. Next slide, please, Mara. This is a different way of looking at the evolution of BIT signed. Once a treaty is signed and enforced, it remains in effect until superseded by a new one. So it also makes sense to look at the cumulative number of treaties signed. And looking at the cumulative number, it's economies which are amongst the largest FDI recipients. We find that they have also signed the highest number of bilateral agreements, with PRC, Korea, and India being amongst the top. In recent years, there have been some concerns about investment agreements as well, since these impose costs to states. And there is a view that they're not always effective in fully delivering their objective. So while there has been a rise in cross-border investment flows in the last 2 decades, we've also seen a rise in the number of investor-state disputes, and mostly involving middle-income countries. So with this aim, we developed a next slide, please, Mara. So with this aim, we developed a comprehensive data set in order to create a more granular classification of provisions enforced by Asian economies. So this database only covers treaties that Asian economies have signed, both with other Asian countries and globally. And it covers around 1,000 treaties. It allows firms to directly compare agreements across countries where they may locate their affiliates, and policymakers to identify relevant provisions in their treaties, which could be incorporated in other treaties or multilateralized. So 5 new provisions were added, which are marked in red here, and to the existing 10. And overall, the 15 provisions were grouped into 5 closely related provisions were grouped into BIT families, which cover, the first of which covers entry rules for foreign investors. Treatment refers to the treatment given to foreign investors against domestic ones. The provisions relating to scope provide the definition of investment, jurisdiction, and duration of treaty. And expropriation refers to arrangements for host states to take over foreign assets, circumstances in which states may take over foreign assets. And finally, dispute mechanism, which specifies the existence and specific features of dispute settlement. Next slide. So looking at the new provisions in more details, we introduced a provision to capture the importance or the presence of public interest obligations, which include labor, health, environmental standards, for the purpose of avoiding disputes post-establishment. We also added a provision on performance requirements, which are an often used instrument of industrial policy designed to protect or support in certain industries or regional development policies. We also added exception clause, which provides exceptions to protect strategic industries in times of economic crisis or shocks. And finally, we introduced two provisions relating to investor-state dispute settlement mechanisms. One which captures the existence of such a mechanism, and the second one which looks at through a textual analysis, looks at the procedures for appointing arbitrators, arbitration avenues available, and obligations to consider. So in effect, how transparent are the procedures through which these dispute mechanisms can be brought into force. I should mention that all these 15 provisions are coded as either a 1 or a 0, with a 1 signaling broader treatment or more rights for the investor, whereas a 0 is restricted rights for investors. Next slide. So just providing some descriptive stats on the different provisions. At first glance, it seems that there is a great deal of heterogeneity amongst treaties, with emphasis on a varying number of provisions. If you compare the provisions in intra-Asian bilateral investment treaties compared to the treaties that Asian economies signed with economies outside the region, we see that generally intra-Asian agreements tend to provide less protection or less rights to investors, and also quite often have a greater incidence of performance requirements, which, as I mentioned, give states more room to conduct industrial policy by targeting certain sectors and industries. Next slide. So this just shows that the number of state investor disputes has steadily increased over the past 2 decades, both globally and in Asia. This data is from World Bank's International Center for Settlement of International Disputes, or ICSID database, which covers the majority, more than 90% of total ISDs worldwide. So based on this, we find that there have been a total of 673 cases globally, both ongoing and concluded since 2003, of which 83 concern Asian economies. However, in recent years, less than 10% of all cases annually involve Asian economies. And the right panel shows that there's the sectoral concentration varies amongst ISDs, with most cases concentrated in oil, gas, and mining, followed by the electricity sector. So next, I turn to Rolando.
Thanks a lot, Fahad. Next slide, please. So with this description of the provisions and some of the questions that we want to address, what we wanted to look at first was how do they look, these aspects, in terms of entry mode, sectoral distribution, and the BIT templates that Fahad briefly mentioned. And what we see in the descriptive statistics, this is an example comparing the mergers and acquisitions and greenfield investment, both on the extensive and intensive margin. So the green columns represent the average number of deals or the average deal value allocated to a project in the context of a BIT or without BIT. So the existence of a BIT, just from these descriptive charts, seemed to be not entirely relevant for the case of mergers and acquisitions. And that was one of the points that we wanted to explore more. Whereas in the case of greenfield investment, there was a more clear difference. This is one of the reasons why we try to explore a bit more this sectoral distribution and the sectoral allocation in the context of the existence or not of a BIT between countries. For the purposes of this work, we focused solely on Asian investment, so both inward and outward FDI involving at least one Asian country. So this might also give a slightly different view to other works that have focused on a global investment. The reason for this was one, to focus more on the provisions that we introduced, as mentioned by Fahad, and to give an idea in terms of the number of provisions that have a BIT, sorry, the number of investments or transactions that involve a BIT is around 10%. So 90% of the flows don't really are associated to the existence of a BIT. Next slide, please. So with this, what we proposed on the empirical model, and this is ongoing work where we really want to seek also the feedback of the colleagues, and especially Rodolphe, Jotin, and Christina, who kindly accepted to join us, was to basically test some of these hypotheses. The interest variable, as we mentioned, are these projects that are tracked at the firm level and then aggregated on the ownership side. We used mergers and acquisitions and greenfield investments, both in terms of projects and deals and value investment, as I mentioned. And we tried to focus on these different dimensions. One, on the sector. We also we focus a lot on the new provisions, which were described by Fahad, and we introduced a standard gravity model, basically using a Poisson likelihood model, a PPML, and that builds also a lot on the work that has been done by Rodolphe and by other colleagues to test this hypothesis. We focus as well on a couple of aspects that we are exploring. One is the entry into force of the agreements. So that's a point that we wanted to assess a bit better, to see how the existence of these agreements that are sometimes very old, not necessarily up to date in terms of the standards, how relevant they are and how have they evolved. And it's something that we see in the composition of provisions in the database, that the composition has changed over time. We also look at some aspects related to the top deals and the non-top deals. So basically trying to see if the results might be driven by the top deals in terms of both number of deals and projects and deal value. And also we look at the quartile distribution of the deal value allocated. So these are some of the aspects we are looking, but of course this will benefit a lot from the comments today to improve this framework. Next slide, please. So just to present briefly and without going into too much detail, we share with the discussants a longer presentation. For now, we will focus on just some of the main features and main results. Basically, we run this gravity model using the variable of interest, the M&A number of deals and deal allocated, and the greenfield investments, projects, and capital investment value. And what we want to explore, and for this, we want to see first what involved transaction. And basically, we use a number of controls for this, standard controls in a gravity model, governance indicators from both the sending and receiving country, and we basically establish how important are these. The results, I have to say, the BIT variable is also measured, and this is following on Rodolphe's work. work as the present of at least 2 years. So to take into account some lag in terms of the entry into force and the use of the BIT in this type of investments. Next slide, please. So to summarize very briefly, what we see is that the effects and the impact, or at least the association of the BIT provisions seems to be more pronounced on the case of greenfield investments and more concretely on the extensive margin and the number of projects. These coefficients here represent separate coefficients for each of these specifications using one of the BIT provisions. So what they suggest, at least in this setting, which is a very a more basic one using a cross-section, and that we later extend to a model with a time dimension and country effects, is that the greenfield projects tend to be more sensitive to the provisions. Next slide, please. We do the same using what we call the BIT families. We have 5 that are part of some of the work that was done in the past. We have other families that we are exploring as well. For example, in the database, we have what is called the anti-discrimination index, which is basically a rearrangement of these provisions, covering those provisions that are more relevant to anti-discrimination of investors. And in general, we find robust results in terms of the greenfield investment. Next slide, please. We try to reproduce also some of the work that was done by Rodolphe in terms of taking into consideration a different structure for the dataset and basically using a stack regression, considering all the number of deals in both greenfield and M&A, and using basically an interaction term to measure how the effect looks in the case of M&A and greenfield. In the case of M&A, as we could see in the interaction term, we have a negative coefficient, which would tend to suggest that the relationship with the provisions is different. In the next slide, please. What we see in the case of greenfield, this is for the BIT family, so we see this kind of effect. I think we don't have that slide, but basically for the case of greenfield, we see a positive coefficient on the interaction term, and basically suggesting that there seems to be an additional and positive association with most of the provisions in the case of greenfield. Finally, what we are doing here is trying to explore what is the relationship to the sectoral allocation, basically using Rodolphe's model where we have stack regressions by sector. Here the baseline sector is manufacturing. What would suggest these results is this, in the case of an M&A, the primary and to some extent services have more a negative association with these provisions. Whereas in the case of manufacturing will tend to be benefit more from the existence of the provisions. Next slide, please. Here we have the result for greenfield investments, and in the lower table, that's the result I was mentioning in terms of the more positive effect also on the services sector for greenfield. Next slide, please. So the key results that we have at the moment, they hold on some of the sensitivity tests. We still are trying to understand better the role of the sectors. We did the estimation of a model of cumulative FDI, and as I mentioned, with a time dimension where most of these results hold. We also included a country and time fixed effects and sectoral and subsectoral effects, and most of the results hold, although we have some questions on the case of the sectoral impact. We also use additional controls in the case of various measures of governance, business environment, and we also do some interactions with the RTAs and the existence of RTAs within the country pairs that we are studying. And we are doing some alternative specifications, as I mentioned, dividing the sample by top country pairs, so the top number of deals, quarter regressions by deal value, and using different estimators apart from the PPML to check for the results. Next slide, please. So to summarize some of the key findings so far in these preliminary results, what we can see is that the impact tends to be contingent on the type of entry mode between M&A and greenfield. The initial estimates suggest a positive and significant association between the BIT provisions, the 15 provisions, and the greenfield investment. The provisions related to treatment seem to be the most important when we look at the magnitude of some of these coefficients. Also, among the new provisions, the public interest, the exception clause, and access to arbitration tend to have a more significant effect in the case of greenfield projects. And finally, on the sectoral story, we find that the impact of the provisions tends to be more beneficial for manufacturing and more specifically on the greenfield investments. Next slide, please. Extensions that we are looking at the moment are one, to consider a broader sector classification where we can see also the role of low and high-tech manufacturing, differentiate between agriculture and mining, and also look at different type of services to see these effects. Also, as Fahad mentioned, we are looking at the BIT templates, and this is a question that is also important in the sense that many of the agreements with extra-regional outside of Asia seem to follow a more specific or different templates and tend to have also a different structure. So this is something we are looking in a simple way. Basically, one is looking at a classification of templates of each BIT, and we are trying also to cluster some of these templates by provisions and try to find like what groups of templates we can identify from the database and then analyze what impact do they have. We also are looking at temporal differences on the year of signature, as I mentioned, just to look at the generations of BITs. And we are looking at the interactions of BITs with RTAs and with other governance measures. And finally, we're starting to look at a more causality framework to see how to identify better effects of the BIT. And we are doing this with a difference approach. But that's something maybe we can discuss during the panel. Thank you very much.
Rolando, thank you, Fahad, for excellent presentation. The findings are very interesting, in fact. We have three distinguished experts, both in-house and outside. Well, first, we have Yutin Jinjarak, Senior Economist in Economic Research and Regional Cooperation Department, ADB. Just recently joined, and welcome to the webinar, and welcome to ADB. We also have a professor of economics, Professor Rodolfo Desborde from Schema Business School, Paris, France. So are you actually now connecting from Paris?
That's correct, yes, from Paris, yeah.
Okay, good. Okay, and finally, at the list, we have our own principal counsel from the Office of General Counsel of ADB, Christina Park. Okay, so I hear Yutin has another commitment, so he has to leave before the session concludes. So I'm going to invite Yutin first to share some comments and observations he has on the presentation. Yutin?
Sure. All right, then I have a slide. I think Rolando has it. Okay, all right. Well, first, thank you, Sin-Yong, Rolando, and Fahad for including me in this interesting program. Can I have a next slide, please? Okay, so this is my comment. Now, to fix my comment, I'll use Vietnam as an example because Vietnam I believe that most of us agree that Vietnam attract most of the FDI into Asia for the past 20 years. So if you look at the graph, you see that there are practically two episodes of growth of FDI in Vietnam. The one that is significantly higher than the other, that one is in 2008. Now, first I would like to point out is when we look at the data, right? FDI market data is one and UNCTAD data is another. But if you look at the government's data from the official statistics, you may notice that, for example, in 2008, the blue one, the blue bar, that is the registered capital, and the red one is the implemented capital. And you see that there is a significant difference between the two. So I think that is one thing that we should keep in mind. And then we look at the number. We may recall the issues of demand and supply. If you think about the FDI, what is the demand and supply? Well, for the Vietnam's government, probably they want FDI, but they also have their own target. They have the sector targets, they have the location targets, and they have the size target. For the foreign investor, they probably look in terms of the supply of FDI, looking to Vietnam in the context of Vietnam's comparative advantage. And this could be the textbook comparative advantage, like Heckscher-Ohlin type factor endowments, or the institutions, right? And I would say that the roles of BITs fit in this institutional type of comparative advantage. And the foreign investor may also look into Vietnam because of market access, maybe the Vietnam's own market, or using Vietnam as a platform for production and exporting to other markets. Okay, so these are the first comment that I like to point out: demand, the role of demand and supply, and also the data that we are looking at. Now, I have about 3 more comments. The first one is if you look at the BITs, right? Bilateral investment treaties. Consider the case of Vietnam. So Vietnam have had 2 major investment law legislation. The first one is in the late 1980s, and the second one is in the mid 2000s. Now, if you want to map that into the graph that you see on the left, maybe that also explains the growth of the FDI in Vietnam. And maybe not the BITs only per se, right? And there's also another factor for Vietnam, the WTO accession in 2007. Of course, this would affect not only the investment, but also international trade of Vietnam. And there are many studies that looking to what is the benefit of WTO accession of Vietnam across the products, industries, and even regions. Now, let me go back to the UNCTAD data. So I cross-verified, and the UNCTAD data is the underlying data that Rolando and Farhad are using. So I cross-verified the data with the data at the Vietnam's Chamber of Commerce and Industry, VCCI. And if I'm not mistaken, we don't have the investment agreement between Vietnam and US in the UNCTAD data, or in this the BIT database. But I guess we can all agree that the BTA, the bilateral trade agreement between the US and Vietnam, is the major one, the one that's signed in the early 2000s. In there is a chapter, chapter 4, called Development of Investment Relations. The first question is, should we consider is a type of BITS? Although it's not being classified by UNCTAD as the BIT. Now, the third comment is about the trends of the FDI in Vietnam. Again, if you look at the graph on the left, you see that there are some trends, 2 to 3. Now, for countries, because Rolando and Farhad looking at close to 100 countries, right? Now, for countries with different comparative advantage, they may be on a different FDI paths. That is, if you look at the FDI growth across the countries, you see different trends. just look at Vietnam, you see that there are several trends, right? So I think that when we do the estimation, we probably have to consider the omitted time varying variables, because the BIT may be correlated with these omitted time varying variables. And there is one standard test used in international trade, the falsification test, whereby we can estimate the change in FDI, say from 2000 to 2005, on the change in the BIT from 2005 and 2008. Notice the time dimension. We are estimating the FDI of the earlier period on the BIT of later period to check for the growth, whether what we are picking up in the table of results are the true effect of the BIT or whether it's just the trend effect. Right? Now, the third and my last major comment is about when we think about the welfare implication of the BIT, right? We may also want to ask whether the BIT is the trade creation or the trade diversion instrument. Now, talking about the trade creation and trade diversion, I think we should also consider other factors, not only BIT, but also comparative advantage and also international taxes. Consider taxes, right? Vietnam has a corporate income taxes of about 20% as a standard tax rate. If you are looking at oil and gas, this rate could go up to 30 to 50%. But for the FDI firms, they may be entertained with a preferential rate of 10%, 17%, or 15%. Right? Now, I think that this framework that Rolando and Farhad are working on are quite useful and can be extended to study the spatial effects. That is, what happened if the other countries also impose the BITS. Right? So one can look at the FDI as a function of not only the BITS of the country of interest, but also other countries. Now, beyond the BIT, I think we should also consider the taxes, right? The tax rate in other countries. For the multinational, these are quite important. They may look at the BIT as a tool of improving institutions and legal framework in the host country. But we also know that international tax rate differ quite markedly across countries. So I think this probably is something that Rolando and Farhad want to control in their estimation. So these are the 3 to 4 comments that I would like to highlight, but happy to talk more about others with them later. Thank you, Sinyoung. Back to you. I think you are muted. I couldn't hear you though. Am I the only one?
Sorry, I was muted. What time are you supposed to leave? Can I ask you a quick few questions first, or can you join later with other panelists?
I probably have to go in about 10
minutes.
Yeah.
Oh, okay.
Sorry about that.
Okay. Sure. Then why don't we go first with Yatin? Well, you have done quite a lot of work on FDI, in fact. Of course, in driving the FDI, the determinants have been always quite various, right? Like, we see a lot of macroeconomic sort of environment, like also is the economic sort of environment conducive for investment, or if there are also risks, financial risks or sovereign risks, or any even policy risks. And some in many sense, I think also the economists have been interested and policymakers have been interested in a way how the BIT or the tax treaties or any other these international investment related policies can help or guide the direction of size of FDI. So from your studies, from your own study, can you tell us more about, what you see as generally the environment that are conducive for the FDI, and if there are some policies that really exert influence on the size and the direction of investment, especially like a foreign direct investment, what would that be?
Sure. Yeah. Thank you for the question. Now, more recently, I look at the socio-economic impacts of the FDI, focusing on Vietnam in particular, and that's why I use Vietnam as an example. So I look at income convergence, for example, across the Vietnam provinces. So Vietnam has about 60 provinces, and what we found is that the income convergence in Vietnam, partly driven by the presence of the FDI investment. Now, the caveat is that it's not all the FDI that help the income convergence in Vietnam. It's the high-tech FDI. That is one. The second is the role of industry, the agglomeration. The thing is that when we look at the FDI, right? When the FDI is going in Vietnam, normally, if you think about, say, Samsung or the Toyota and so on, when they go into Vietnam, they also bring in the supply chains, right? They also bring in the countries from Japan and so from Korea. So what we found is that there are these industry agglomeration effects that drive the income convergence in Vietnam. So that is one thing. And I think this reflects quite well in the policy agenda of the Vietnamese government. When they want to attract the FDI, they also state quite clearly that they have target industries, high-tech sector. In the past, it was the light industry like garments, but more recently it become more heavy industries and high-tech industries. And they also want to target locations. So some locations that are underdeveloped, they want to extend into those locations. So I think these are the several factors that we found in the data with Vietnam in particular. Mm-hmm. So I think you're right that all the macro factors that we all study, sovereign risk, macro uncertainties, those continue to be important. But there are also factors that think about demand supply, right? When the country demand FDI, they also have their own policy targets. And country would differ in terms of their targets. Some country would, if it are early in the game, maybe they want to exploit their factor endowments. But for country like Vietnam, which been in this FDI for quite some time, now they want to move up the value chain. So these are the things that I think we probably have to factor in when we study the BIT. BIT is one, but there are also other targets that the government want to implement in order to attract the FDI.
Okay. Well, thank you. Also, in your examples, as you have already shown, Vietnam does also care, right? It's not just the Vietnam, right? Like the countries that host the FDI will care about the size of the location where these FDIs actually go, like which sector. They do have some priorities and preferences. And then at the same time, as we have seen, the countries that invest overseas, right? Like China invests heavily nowadays in mining, like natural resources. They have their own priorities and some strategies. How do you see between these demand side and then supply side, different sort of strategies, these bilateral agreement play?
Yes, so I want to add that not only the location and the industry, but also the size. In many countries, including Vietnam, they want to scale up the production size. For example, if you look at the tax incentive in the case of Vietnam, if the corporation is above foreign corporation is above $500 million US, they will be entertained with a more attractive tax rate. So size, location, and so the industries. Now, going back to what you highlight, I think that in terms of the FDI, right? And this I'll try to relate back to what Rolando and Farhad are doing. FDI is one form of international capital movement, and we can all agree on this. So when, for example, large economies like China, Japan, or Korea are investing overseas, not only FDI are going there, other types of capital inflows are going there. Bank loans, for example, are going there. And even some new form of financial commitment, say the swap lines. China has been extending the swap line to many developing countries, Asia, and also in particular in Latin America. So I think given the framework that Farhad and Rolando are working on, probably it's not harmful to add not only FDI into the dependent variable, for example, but also the imports, right? The imports into the country that invests in say Vietnam. So China may invest in say Chile, right? In the form FDI, but at the same time import processed materials from Chile, and at the same time would extend the swap line to the many Latin American countries. So think about international trade and investment. I think that we should try to factor in other forms of capital movement. Greenfield, M&A, these are important, but also bank loans and other form of financial commitments. I think this would be quite important. And I think this can be studied with the data that Rolando and Farhad are working on. So I think this study going a long way. I think with the data that they have and what they are doing.
Okay, thank you very much. Thank you.
Thank you. And sorry again that I cannot.
Thank you.
Yeah, but you've been very helpful, and I think a lot of comments that you raised are very important for improving the draft further. I'm going to invite Rudolf. Rudolf, you have done a lot of also work on FDI allocation between the M&A and then greenfield investment. In fact, I have to actually thank you first because you started this BIT database work, even earlier, and very happy to see some of the earlier work is now becoming to establish a much sort of comprehensive BIT database within ADB, which can be very helpful for a lot of researchers. But you've been in the FDI research area for a really long time. Rolando and then Farhad presented some patterns and then like seemingly different characteristics of M&A and then greenfield investment. What do you believe the factors that are more important for each mode of entry? Again, for M&A or greenfield, do you feel that there are different factors that attract more M&A versus greenfield in certain sectors? Do you feel like certain sectors are more conducive for greenfield investment versus M&A?
Yes. So if I may have a few comments to make on the presentation, and then I will try to address your questions.
Sure.
So Mara, next slide, please. Thank you very much. So just I would like to make a few comments on methodology. First of all, what do we talk about when we talk about FDI? Well, Farhad and Rando have tried to use real data. So I've tried to use real data on real investment project, greenfield or M&A, and that's a good thing because with financial data from balance of payments, you only measure what comes from abroad. And that's only one source of funding. Of course, you can get funding from domestic markets, from external markets, and therefore you may miss a lot of activities. Sometimes this real data is very lumpy, it's full of measurement errors, and sometimes you don't have the data, let's say, for 50% of M&A deals. And sometimes you don't know where the investor come from. Do you have information on the immediate investor or the ultimate investor? So for instance, Coca-Cola may invest in Philippines through the Netherlands, but it's possible that in data, what you have is the parent company, the US headquarters. And that's an issue because we know that there is some kind of treaty shopping going around. So investors try to find the best, in a sense, source company to invest in order to benefit from the best BIT environment. And then with financial data, well, you get lots of data and you can have it for lots of years, but then it's a bit like a stock. You don't really know what you're measuring because reinvested earnings are part of flows, and then you can miss lots of foreign activities. And once again, it can be distorted by transshipping, round tripping. So we know that for Chinese data, you get lots of round tripping. So you get, in a sense, the Chinese domestic investors investing in the Cayman Islands, and then the flow is coming back for various reasons. Then in terms of BITs, so Julian Chase has been working a lot on measuring the different provisions of BITs, but we know as well that there are sometimes they have been signed for a long time. So as Fahad said, sometimes in a sense they can be obsolete in terms of provisions, or they have been renegotiated, or sometimes they are going to be terminated. It's also hard to do time series analysis for all the reasons I've given above. FDI data are very lumpy, so they're very cyclical, and BITs are very heterogeneous. And as I will talk about very quickly, obviously they can be endogenous. When I was looking just at the cross-sectional estimates, I didn't see country fixed effects. So if you are able, in a sense, to measure the impact of GDPs, that means that there are no country fixed effects. And in a sense, it's very important if you want to measure the impact of BITs. Next slide, please, Mara. So just some economic comments, and that's why I wanted to present my comments, Sin Young. That's because, in fact, I'm getting old, so I've been working quite a long time on FDI, and with Ron Davis and Anna Ray, we have a paper in the Canadian Journal of Economics, and we try, in fact, to see whether M&A and greenfield investments is the same thing. And in fact, it's not. M&A, it's about a desire to integrate or exploit arbitrage opportunities. Greenfield, it's about relying more on the firm's own capacities. And what we find that M&A investments are more responsive to barriers, institutional barriers, cultural barriers, or geographical barriers. And M&A, for instance, are more sensitive to the destination countries' institutional quality. So, and looking back at the regulations, we see that as well the BIT of BITs matters. By the BIT, I mean investor-state dispute methods or mechanism. But here we have a paradox, and I don't really know how to explain it right now. For M&A, we see no impact of BITs. And it seems even that there is a non-statistically significant negative impact. Why is this the case? Why don't we find something in line with what I found and other people have found? The fact that institutional quality matters for M&A. Why is it the case? I don't really know. Is it specific to Asia? Is it because firms target other firms which benefit from political links or benefit from their size and therefore have a lot of clout? I don't really know. And I think it would be very interesting to try to test interactions between BITs and governance, or look at specific firms, do possibly a case study, just to get an idea why M&As don't seem to be responsive to BITs. I see as well that access to arbitration is scarce and getting scarcer in BITs. You mentioned, for instance, the issues with COVID-19. It's possible that, in fact, foreign investors will sue governments for a breach of BITs, and therefore countries are trying to renegotiate or even terminate their BITs. But in that case, if you don't have access to arbitration, if you don't have to bite in BITs, well, it's a bit all ado for nothing. I mean, you can write lots of stuff on papers, but if there is not a way of enforcing what you've written on paper, it's once again for nothing. And then we spend lots of time thinking about BITs. So possibly there will be FDI by 30%, 40%, 15%. But then, of course, as has been pointed out, other determinants matters. Governance, of course, corporate taxes. I've seen on the chat government incentives. All these steps may matter even more than BITs. And Mara, last slide. So some suggestions, trying to be constructive. First of all, there is a nice paper in the trade literature by Peter Egger and Mario Larch and other people. So it's quite interesting because they're trying to model the endogeneity of PTA, and possibly you could extend the approach to BITs. Something else which has been mentioned, and that's very important. How do we think about BITs? I wrote PTA, but in fact that's for BIT. In a sense, if you have one country signing a BIT, will it benefit other countries? Will it harm other countries? Or is it a positive sum device? So we've got to think a bit more about the general equilibrium effects, because we are still not sure what you gain from signing a BIT. Maybe the partial effect is positive, but the overall effect is zero or negative. Then, as it has been said, we've got to think about the links between BITs and PTAs. Foreign firms are part of global trade, and therefore trade and FDI are linked. And finally, for better identification, of course, we could try to do a kind of difference in different analysis, try to exploit sector-specific variations, or just yesterday, working on the presentation, I've seen a new kind of IV estimator for gravity models, trying to exploit, in fact, what is known as multilateral resistance, trying to construct instruments based on internal information, if you want. So I will communicate the paper to Rando, and maybe that's something useful to try to assert the causal impact of BITs. Thank you very much.
Thank you, Rodolphe. You have very good comments. In fact, you know, one of the comments were exactly same that I was going to raise. I was also thinking that you know, again, the PIT could be not necessarily just one sort of external independent shock. It could be signaling there's certain institutional qualities of the country that already existed and might you know, favor certain sectors, certain investment to other. And then so it's kind of like, you know, there's an indigeneity issue, right? So something that I think in the next paper may have to look at more carefully. Well, we have the only legal expert in our panel, Christina. I think you can actually bring in a lot of interesting insight. Can you tell us more about, like, you know, the development these days in Asia, how countries are approaching the BITs, and especially related to the investor-state disputes? Increasingly, there are these ISD in like mining and the natural resources. You know, China has already shown some examples. So, but there are, of course, other areas, right? You know, in the financial services, like you know, example like in Korea. So what do you see as these increasing ISDB, and also the impact of these type of provisions of a BIT on FDI in Asia?
That's right. Thanks, Sin Young. First of all, thanks for inviting me to be part of this important discussions. So yes, as Rodolphe mentioned, access to effective dispute resolution. In the case of investment treaties, it's arbitration. They're hugely important in the context of, I guess, COVID times. because as it was mentioned earlier, it's predicted that because of the COVID measures, a lot of disputes may arise from that. And it's also important in the context of countries trying to meet their sustainable development goals. So as you mentioned, there's been a lot of disputes related to, in the interest of public interest for betterment of environmental protection, climate change. There's been a lot of disputes related to renewable energy. The quality of the type of the investment treaty provisions are really important. And I'm going to speak on basically two provisions. So the investor state dispute system, so arbitration, access to arbitration, and the public interest provisions that are evolving right now. So I will focus the next few minutes on these two provisions and how they, will impact FDI and also in the context of COVID times and our SDG goals. I just have a few slides. There's just so much going on the legal front that I just wanted to organize them. So I'll just put them on, okay?
Okay.
Thanks. Okay, so can you see my slides, Sin-Young?
Yes, you can see.
Excellent, excellent. Okay, so the first, I guess the first provision I will focus on is the ISDS provision, and there's been a lot of criticism about ISDS mechanisms in investment treaties. Basically, a lot of people say they favor foreign investors, they lack transparency. They result in disproportionate award amounts not tied to states' ability to pay or amounts invested. And I think the most recent example is the ICSID award in the amount of almost $6 billion against Pakistan under a BIT between Pakistan and Australia. So there's been a lot of criticism. So because of that, and as you said, as Rodolphe said, effective dispute resolution between the host state and the investor is critical. It's critical in attracting FDI because foreign investors they need a fair, neutral, effective, and efficient way to resolve their disputes. I'll just give a brief background on how the ISDS mechanism works. It's basically a procedural mechanism which an investor may claim for compensation for a violation of a substantive investor protection provision, such as fair and equitable treatment and expropriation without compensation. And then the most common dispute settlement mechanism under investment treaties is international arbitration under the ICSID Convention. So this is a standalone regime entirely detached from national laws and national courts. But there are some BIT arbitrations that are under general institutional arbitration rules, such as UNCITRAL rules or institution arbitration, such as ICC or SEAC, and the New York Convention, it's a separate convention on recognition and enforcement of foreign arbitral awards, and it's also subject to national arbitration. So you have these two different regimes, but really the procedural mechanism is international arbitration. So a key development in the context of dispute settlement is the lack of transparency. And transparency is important, especially in investor-state disputes because of, because of the importance of public issues. Rather than, in international commercial arbitration, it's really between business parties, and the advantage is confidentiality. They want to keep their business disputes separate. But in investor-state disputes, there's huge public interest considerations. So a lot of people have been saying, these are like secret courts, these are secret mechanisms. We want more transparency. So there's been efforts over the last few years on improving transparency under investor-state arbitration. So the two developments I'll talk about is the UNCITRAL rules on transparency. It was introduced in 2014. There's also the current and ongoing ICSID rules amendment process. Also, there is the UN Convention on Transparency and Treaty-Based Investor-State Arbitration. It's called the Mauritius Convention, and it went into effect in October 2017. But the uptake has been patchy. It actually doesn't have good uptake. So I'm really going to focus on the UNCITRAL rules of transparency. When we talk about transparency, what we're talking about, is disclosing who the parties are, in what economic sector, under what BIT or other international investment agreement. Also, we're talking about, whether, awards can be published, because as of now, awards are kept confidential in many instances. Also, whether hearings can be public. So those are the types of discussions like going around the transparency developments. So under the UNCITRAL rules of transparency, basically parties can agree to, disclose certain information about their disputes. So it's a big development. Under the exit rules of amendment, it's still to be approved by the member states, and it introduces a new chapter, and it's pretty self-explanatory. It's called publication, access to proceedings, and non-disputing party submission. These are, big changes actually, and I think the only one that I probably have to explain is the non-disputing party submission. It just means that non-disputing parties, third parties, can submit written submissions like amicus curiae on behalf of whoever they're basically endorsing. So that's on transparency. The second one basically is on the broader issue of ISDS reform. So UNCITRAL Working Group 3 has been leading the effort on this, and they are considering fundamental changes, structural reforms, and they're also considering incremental reforms. So under the structural reform option, it's basically consists of creating a multilateral investment court system. So this would be a complete revamp of investor-state arbitration. In fact, actually, in 2019, the EU Multilateral Investment Court was proposed. So basically, people that support these multilateral investment courts, they say it'll, result in more consistent and predictable outcomes. Whereas opponents, they basically raise concern about lack of expertise. And expertise is actually one of the key advantages of arbitration, because you have experts adjudicating your dispute versus, if you go to the court system, you don't have that specialism. Also, people that are against it are saying, under this proposal, states will be appointing the adjudicators. So they're saying there could be some bias in this. And then the incremental option is basically aimed at various measures to improve the current ISDS regime without changing it fundamentally. So you can see here, there's the creation of advisory center, treaty parties, they can be more involved in treaty interpretation, creation of dispute prevention and mitigation mechanisms, and also there's efforts to ensure that the arbitrators' appointment on how arbitrators are appointed, and ethics related to that. So related to ethics, UNCITRAL Working Group 3 and ICSID, they published the draft code of conduct for adjudicators, which addresses the issue of independence, impartiality, duty to conduct proceedings with integrity, fairness, efficiency, and civility. So with these reforms, they're supposed to address the quality of ISDS mechanisms under investor-state dispute resolution. Therefore, also increase, the potential to attract greater FDI. Another important development which is evolving is the public interest provisions, and this really comes into play in the context of COVID, during the pandemic and also the recovery phase. Countries' efforts, like I mentioned before, countries' efforts to regulate to further health environment, sustainable development. So the drafting, and this was actually brought up by our previous speakers, the drafting of these public interest provisions have been evolving, and how arbitral tribunals have interpreted them have also been evolving over the years. You know, generally, investors look to BITs, and they want to, you know, have legal certainty and predictability. So when things change under them, when countries issue a new regulation in the interest of public, for public interest, this can cause disputes. This can cause a lot of issues. So disputes actually can, you know, arise when countries regulate. So, you know, you mentioned, I think I mentioned earlier, in other countries, there's been, especially in Spain, there's been the spate of renewable energy disputes in connection actually with the Energy Charter, which is a multilateral investment treaty. But basically, when countries come out with regulations to, you know, for sustainable development or for climate change, it can, you know, investors could argue, hey, you're changing what we agreed to. So then they file disputes. And then, you know, all this stuff happens, which I'll get into a little bit more detail later. But, you know, it's not good. So there's been a lot of these types of disputes because countries are now taking into account sustainability measures, and then you know, there's all these COVID measures that are happening, right? So I guess there's fear that there's going to be all these disputes related to these COVID measures as well, when it's in the interest of public. So, you know, with that, this is just a generalization, but, you know, in the older investment treaties, the notion of public interest is very broad. So they use terms like public purpose, public benefit, public order. There's like nothing really specific. They don't specifically mention for environmental protection or for whatever. So that's like sort of in the older generation BITs. And over time, various arbitral tribunals, so these tribunals that listen to these, adjudicate these disputes, have recognized a state's right to regulate in the public interest. But they've also narrowed it. So they narrowed it to particular circumstances, and basically also said that investors need to be treated fairly, and it's just nothing more than ordinary government regulation. I guess just to give you a flavor, this is like an excerpt from a arbitral like tribunal, and this is how they've construed it. They basically said, in the normal exercise of their regulatory powers, they adopt in a non-discriminatory manner bona fide regulation that are aimed at the general welfare. So I guess the takeaway is that, you know, these regulations shouldn't really discriminate against foreign investors versus domestic, should treat everyone fairly. But, you know, with these arbitral awards, arbitral tribunals, there's been some, inconsistent interpretations. And I don't know, I'm not an expert, but I would say it's a bit inconsistent. It could be inconsistent and patchy, and I guess that relates to the whole issue of, you know, reforms related to, you know, arbitrators. Additionally, there are these like public interest obligations that are starting to get embedded in these investment treaties, and these are like meant as a signal to influence investor behavior. So these aren't legally enforceable obligations, but they use wording like, you know, best efforts to improve the environment, best efforts to help with climate change, stuff like that. So it's very it's a looser language, but it's a signal to the investors that the government is thinking about this. In the recent treaties, so the recent treaties have now evolved. So in the recent treaties, there's more explicit right to regulate in the public interest. And there's been two approaches. So some treaties added a relevant explanatory clause. So it's a specific explicit provision. And for example, these types of explanatory clause is found in the annexes of the expropriation provision, which are, I guess generally phrased as, except in rare circumstances, non-discriminatory regulatory actions by a party that are designed and applied to protect legitimate public welfare objective, such as public health, safety, and environment, do not constitute expropriation. So they've embedded these type of provisions. Other treaties have also introduced general exceptions, which explicitly include measures relating to protection of environment, protection of the climate, and these are becoming more common. And I guess the legal effect is that if these exceptions are met, the investor really can't rely on the other substantive provisions like fair and equitable treatment under the treaty provisions. So it's I guess these exceptions, public interest exceptions, are now carving out a space for states to move more towards sustainable development. So in the context of COVID, it'll be interesting how these arbitral tribunal, under these disputes, how these arbitral tribunals construe the COVID measures. For example, cases where projects are canceled or suspended because of COVID, would they amount to indirect expropriation? So this is an area to keep track of, and they're signaling that disputes are coming under COVID measures. Lots of law firms writing about this. There's been concern raised by governments through different channels, which I will talk about later. And of course, states also have certain defenses that they can assert when they get sued. I'm not going to go into detail because these are just complicated, but just they do have defenses like emergency clauses, force majeure, necessity, security defense. Again, how these defenses are construed in the context of COVID and public interest, it'll also be it's also evolving. So just right now, like I said, there's fear. Actually, there's feared and heated discussions that COVID-19 will increase liability for states under investment treaties, and this is especially true for BITs that lack the exceptions I talked about, the explicit public interest provisions. So maybe under the older generation of investment treaties, it's more problematic. But there's a great fear. So there's been conversation, a call to suspend treaty-based arbitration for all COVID-related measures, and more specifically, the Columbia Center for Sustainable Investment. And they've said that they've been getting, informal inquiries from states. They're calling for an ISDS moratorium. They're calling for immediate moratorium on all arbitration claims by private corporations against governments using investment treaties, and they're actually calling for permanent restriction on arbitration claims related to measures, COVID measures. And they're saying, they're calling for the moratorium because they're saying, in COVID times, governments need to divert resources to people in need. This will help mitigate impacts on countries, and it'll also, avoid regulatory chill. So as I said, it is expected that post-pandemic period may witness, I guess, it may actually speed up countries' efforts to reform their international investment treaties to ensure their right to regulate in the public interest. But at the same time, the challenge is how to maintain, maintain that balance and effective levels to protect investors. So this will be no easy task. So my last slide here. And what can be done about this? so ADB's BIT database is extremely timely. It really has important data in raising this awareness among our DMCs, because they need to know what they've signed on to. They need to know what their obligations are. They need to know what their rights are. And there's also, I'm not going to cover all of them, but I mean, we could talk about it later. But I guess there has been some move by certain states to unilaterally terminate the existing treaty, or renegotiate, or I guess modernize what they have to take into account these considerations. And this is permitted under the Vienna Convention on Treaties, but for treaty termination, it's only when there's like fundamental change of circumstances. So that's still sort of case by case. So these are the these are the. I'm hoping that that the database can really bring out a lot. Thank you. Okay, thanks.
Okay, well, that was a very comprehensive presentation on the risks and some challenges of the international bilateral investment treaties. Well, I mean, as probably not having to understand all said, but still, we understand that in fact, international treaties will have a lot of influence on how the investors make decision on the foreign direct investment for developing countries. Rudolf, I was going to actually ask, in your work, if what she also mentioned a lot about the national interest, right? Like a public interest. Are there certain factors or some specific provisions that could be conducive for promoting some of these public interests, and then how can they be captured in the BIT provision? Is there any evidence that having certain provision actually effectively work, moving the FDI or investment in certain direction for promoting this public interest?
Right. In terms of public interest, it really depends how we define it. If by public interest we mean, let's say, a better legal environment, obviously BIT may help, and that's in a sense the purpose of BIT is to promote and protect foreign direct investment. But then, as has been said by Christina, there is a clash between what sometimes we mean by public interest, that is to say, for instance, the ability, let's say, to enforce public health regulations, and we've seen the case with Philip Morris, for instance, with big tobacco companies or sugar companies, or with pollution. So in that case, there is clearly a clash between what we mean by public interest in terms of public law and public interest, let's say, in terms of investment law. And that's why it was interesting as well what Christina said, that sometimes you've got to renegotiate the treaties, that is to say, to make sure that in a sense the state keeps discretion in some public areas, like let's say health, education, and sometimes to make sure that still the state, for instance, don't have the right, let's say, to expropriate foreign investors. So there is a clear balance to be made. And I would like to say sometimes I find a bit, it's not annoying, but there is with BITs, in a sense, a loss of national sovereignty. And that's because, in a sense, we don't trust domestic institutions. So, and I see it, as a second best solution, in a sense, instead of having BIT, sometimes it would be better just to improve domestic institutions, to give faith to foreign investors in domestic institutions. And then we don't have to go through BITs, international arbitration, the lack of transparency, if we can trust the domestic institutions.
Okay, thank you. Well, we are running out of times. So before closing, I would like to get our speakers, presenters, in fact, give a response to the comments that they received. So Fahad and Rolando, can you give your feedback and responses to all those comments raised? 1 minute each, please. Rolando, you can start first.
Rolando, you're on mute.
Thank you, Sonia. Thank you, Sinyon. Sorry. And thank you to all our panelists for these very constructive comments and for allowing us to put together some different strands of the literature, empirical and legal, trying to put it together now in this project. Just to respond very quickly on Jothin's comment, I was just checking. We do have information on the example he raised on Vietnam, US, on the development of investment relations. We have these provisions also codified for a number of PTAs. And it would be good also because we will be able to compare it. We are not using it in this empirical exercise, but we will be able to include those provisions as well. Also, the neighboring effects model that he mentioned is something that we had been thinking as well. And we will definitely try to explore a bit further how we could do it and how we could kind of consider the effect of the peer effect also for the countries. To Rodolphe, thank you again for all these very constructive comments. I mean, you know very well the work we are doing, and I think there are some things that definitely we would like to consult with you. Why the ISDM is not important for M&A? I think, as you mentioned, there could be some issues on terms of estimation. We also thought in terms of the codification we are doing, we divided this in two different provisions, one on access and one on transparency. Well, so what we saw is also that the effect tends to be diluted between the two, and it's something maybe we can explore a bit further. But in terms of your general comment about is it a BIT a positive sum or not, or is I think it's more related to Jotins also in terms of how does that affect the allocation, not only in the country itself, but its neighbors, and we can definitely look at it. And the topic of taxation is coming a lot, and we have received also some questions on that, and we definitely would like to explore it as well. And finally, for Christina's comments, thank you so much for also opening also a bit this box to people who are not as familiar with these concepts. And we definitely would like to explore this public interest a bit more. It's a new provision also, and we hope we can also find some empirical findings around this new provision. Thank you.
Fahad?
Yes, thank you very much to all three panelists for very constructive and useful comments, which will help us to improve the empirical analysis and guide our research questions going forward. I completely agree that the question of whether BITs are trade diversion, divert trade or create trade, that's very important, and that's something that we should look at. Based on preliminary results, we saw that BITs generally promote greenfield FDI, which tends to be more trade promoting and GVC linked, especially in manufacturing. But that's a question that's worth looking into more, and completely agree that looking at BITs in isolation doesn't make any sense. It's part of a broader menu of options, which is why it's important to look at its interactions with RTAs, with existing governance quality, text treaties, and other factors. And this might actually also, adding to Rolando's point, might explain why we don't find much of an impact in our empirical analysis on M&As. The fact that we are already controlling for institutional quality might capture some of that role that BIT plays in improving governance. But going forward, we should look at the interaction effects. And finally, based on Christina's comments, we should definitely try to further also compare different provisions more rigorously and try to see how they complement or compete with each other. So thank you very much.
Okay. Thank you, Rolando. Thank you, Fahad. And thank you very much for Christina's excellent and comprehensive presentation on legal reforms in Asia. Also, I appreciate Rudolph's excellent comments and then suggestions for improving the paper and ongoing the work in the BIT and then FDI relations. Thank you everybody for participating and also joining us today for the RCI pod. Next RCI pod series will be replaced by Asian Impact webinar on digital transformation in post-COVID world next week, 29 September from 2 p.m. So please join us in Asian Impact next week. Thank you and hope to continue the discussion. Thank you very much.
Thank you. Thank you, Sinyo.
Thank you.
Thank you. Bye-bye.